Hi, my name is Bruce Roth, and my guest today is Dave Horwoodell, who's an enrolled agent and the founder of Torchlight Tax and Financial Services. Dave, the question I'd like to ask you today, it's a simple question. What is the Internal Revenue Service's statute of limitations, and what are the implications of it?
Okay, so when the Internal Revenue Service assesses a tax, they have 10 years in which to collect it. If they don't collect it within the 10 years, the tax goes away. Now there are limitations on this. If you get an offer in compromise, there can be fine print on it, but in general, it's 10 years from the assessment date. For example, let's say in 2005, you owed money, and for the year 2005, on April 15, 2016, you filed your tax return. You say, I owed $10,000, and I'm not going to pay it. It's April 15, 2006. On April 15, 2016, if they haven't collected, they can't. That debt goes away. And this is a very important thing to be aware of, because as you're approaching that date where the 10 years is going to be up, then the IRS is going to try to figure out a way to collect from you, but if they can't, it's going to go away. And it's oftentimes...
So they're going to push on you knowing that's coming up, but knowing you may not know it.
Right. And also, you might also at that point in time, supposing that you have 2 years to go, and you're having, a fair income 1 year, not a great income, but you're expecting to make a lot more money, that would be a good time to file for an offer in compromise, because they're going to look at your projected income and say, well, he's only got 2 more years to collect, and so we're going to be able to collect this much money from him. So they're going to accept a lower figure than they would if they had 6 more years to collect.
Okay.
It's something that you need to be aware of as part of all the IRS calculation. It's not necessarily true that, they're always out to get every dime they can, but if you're aware of the IRS statute of limitations, it's something you should know about. And it's also a key point. If you don't file your taxes, and the IRS files your taxes for you and assesses it, that's when the statute of limitation comes about. Now, if you made $100,000 in 1995, and by whatever means that you did it, and they don't know about it and you don't know about it, and they find out about it, it's never been assessed. No statute of limitations has started. So it's only occurred when they actually have an assessed liability, but it can be you filing the tax, or it can be them saying, we're assessing this liability because we know you owe it.
Great. Thank you so much.
You're welcome.
Thank you for watching.